Good afternoon. Thank you for joining us today for our first quarter 2024 review and market outlook webcast. My name is Michael Musio. I'm the president of FBB Capital Partners, and I'm joined by my colleague, as always, Michael Bailey, who is our director of research and chair of the FBB Investment Committee. Working behind the scenes, also as always, is our friend Katie Bogley. She is the little logo that you see of FBB, so you won't be hearing her today, but she's making it all work. And Katie, thank you as always. Today, we intend to review the first quarter of 2024 and look ahead to what may lay ahead for investors for the balance of the year. We'll then have an opportunity for some Q&A that will address previously submitted questions and allow for live questions on the fly as we go along. A few housekeeping items. You'll note that while you can see and hear us, as this is a Zoom webcast, attendees will remain in an anonymous view-only mode. However, we expect and are eager to answer your questions as they come up. If you look at the bottom of your screen, right in the middle of the screen, you'll see a little Q&A link. You can click on that, type in your question. It'll come up, and I'll take a look. We're going to try to get to all the questions that we can today. To the extent that some questions are similar to others, we're going to try to combine them in the interest of time and get the main points and also hopefully the main answers. I'll introduce each question as it comes in, referring to the first name of the questioner, and then either Mike or I will give it a go. Finally, as you heard there at the top, we are recording the call today, and that recording has begun now. As we begin today's discussion, let me remind you of the fact that today's commentary is based on the facts as we see them today, which of course are ever changing. Please note that any reproduction or transcription of statements made during the call without prior approval is prohibited. Should you know someone who you think would like to listen in, you may direct them to our website, and they can find a recording there probably later today or this evening. Also, please note that all forward-looking statements made during the call are subject to risk and uncertainty that could cause actual results to differ materially from the expectations and assumptions that we just discussed today. Finally, please review our complete compliance statement disclaimer at the end of the webcast. We'll spend a moment there as we're starting Q&A, so you can review that. With that, I'll turn it over to Mike Bailey. Mike, let's get going. Thank you.
Great, thanks, Mike, and thanks to everyone for joining us today. So today we're going to take a look at the bullish move in stocks related to artificial intelligence or AI. Then we're going to turn to the broader economy, look at monetary policy, and then examine how we're positioning, especially in an election year, before we take your questions. So with that, let's go to the next slide. Okay, so perhaps many of you, like my family, has been busy making March Madness brackets for college basketball. I'd say at the same time, we're seeing some similarities with stock markets. In a tied game of basketball, you keep playing in overtime. In a similar way, current markets feel like we're in extra time, especially for high-growth tech stocks related to AI, including some of the Magnificent Seven you may have heard about over the past year. They had a really big performance in 2023. Demand is still growing for AI-related technologies, and stock prices are continuing to respond to that demand this year. However, let's take another look at these high-growth tech stocks and see if this overtime period may be coming to an end soon. Next slide. Okay, so before we take a look at something called a hype cycle related to new technologies, let's turn to our first poll question. I'll hand it back to you, Mike.
Great, thanks, Mike. So we're able to post that there, Katie. There we go. So given the move in AI-related stocks over the past year and a half, do you think that we are in an AI bubble? Yes or no? We're going to keep the poll questions simple today. Yes, no's, high, low, that type of thing. All right, very good, Katie. Fairly evenly split, Mike. 58% say yes, 42% say no. 26 or so people participating, so there you go.
Great. So a little bit of a split result there, maybe a little bit more leaning towards the fact that we are in a bubble. We are seeing a lot of excitement for these technologies and for these stocks. And frankly, time will tell if there's any kind of change in sentiment. However, the flip side, things could keep running. We could be in early innings here for AI. We can compare this to, for example, cloud computing. These are companies like Amazon, Microsoft, Google. If you go back to 2014-15, this was just kicking off, and we're still seeing some significant growth in this technology 10 years later. So we're going to have to wait and see. However, we thought it'd be helpful to compare some of this AI excitement with more of a general framework for looking at some of these new technologies. So sort of this idea of a hype cycle. If you take a look at the bottom left and think about when was there a trigger for AI for this move in stocks, probably have to go back to late calendar 22 when we saw the launch of ChatGPT. This is a technology can take a prompt or a question and generate new text. A lot of excitement around that. We're seeing even more advanced things coming out in terms of creating, generating pictures, music, videos, et cetera. So this is certainly, there's a lot happening here for this new technology. We are probably moving up the first curve somewhere between the trigger point and inflated expectations. I think, unfortunately, it is difficult to know, when or if, we'll hit that peak and move on to other parts of the hype cycle, whether that's a downturn or some eventual moderation. However, from an investment perspective, we are taking a diversified approach to owning AI stocks, and perhaps we can get into some more details of that during Q&A. With that, let's move beyond some of the excitement in AI and see what else is impacting markets. Next slide, please. Okay, so big tech has really been moving markets here for over a year. However, another trend we're watching is the fact that investors are getting a little more comfortable with this idea of a gradual slowdown in the economy as opposed to a sharp recession. Jay Powell and his gang at the Federal Reserve, are doing their best to support this idea of a soft landing, and really his number one job is to sort of look at job market, other metrics in the economy, and make sure that they're in good shape. We are seeing employment looking pretty good these days. However, the Fed is really focused on some other macro factors outside of the job market at the moment, which we'll turn to next. Next slide. Okay, so perhaps no surprise here, something that we've been talking about FBB for a long time, but Jay Powell and the Fed, they're really spending a lot of their time trying to figure out the next move for inflation. Now, before we discuss this topic in some more detail, let's go back to our next poll question and get your views. Back to you, Mike.
Great. So we've had a couple months of data where inflation has fallen from 9 to around 3 in different measures, but we've been there for a few months in a row. So given where we stand now, which is closer to 3, where do you think we will be a year from now in terms of inflation? Higher, lower, or about the same as we stand today? Which again, let's splitting hairs here between CPI, PPI, PCE, et cetera. Let's call it 3%. Remember, the Fed's target, long range target is 2%. So higher, lower, about the same as we are now. About the same, Mike. That seems to 65% say about the same, and it's an even split from there between higher or lower on the other third. So, I think that kind of plays into the idea that this last mile, if you will, of inflation, getting from the 3 to 2 is going to be tougher, or less smooth of a path than the first move from 9 to 3 or 9 to 4.
Absolutely, I would echo that. And again, getting some poll results in terms of viewers thinking we're going to see inflation be around where it is. We can kind of relate that to this image of a kind of wildfire. We did see this massive inflation a couple of years ago, in the middle of 22. I think the Fed's done a good job putting out most of that. However, there's still inflation out there, and I think it's been stuck around 3. Again, the Fed would like it to get down to 2. We'll see how that happens. I do think consensus is probably thinking inflation will creep down below 3%, but I think, Mike Musa, to your point, we have seen a couple data points suggesting things could get stuck around 3 for a little while. I think if we were to sort of consider our base case, at FBB, we do anticipate probably some continual decline in inflation. However, we are keeping kind of eyes wide open as far as looking for any signs that we could see prices reaccelerating. So as we sort of connect inflation with the broader investment markets and sort of being aware of a link between inflation and bond yields, let's now turn to the fixed income market and review some of the investment implications of what we're seeing with inflation. Next slide, please. Okay, so this chart shows historical yields for the 10-year Treasury, which many investors use as a benchmark for the broader bond market. At this point, locking up 4.25% yields risk-free for 10 years sounds pretty good. At FBB, we've been buying these types of bonds for a while, as well as corporate bonds, which pay maybe 1% higher. However, the question for investors is what's next? If inflation reverses its downward trend and heats back up, kind kind of going back above 3%. We could see bond yields stay where they are or maybe go a bit higher. However, if we look at more of a consensus view of falling inflation, we are probably going to see bond yields creep back down. With that, as we think about connecting inflation, the bond market, and investment positioning, let's turn to our next slide and kick it off with bonds. So how are we positioning? We just talked about this connection between inflation, which has been moving around a lot, and bond yields. At the end of the day, we do favor locking in some of these current yields, going out 5 to 10 years, especially in case we see inflation come down, rates come down. In addition, as we're looking through bonds that are out there, we like some of the higher quality bonds that are out there. They do provide an inflation hedge, so they tend to generate a yield that's at least in line with inflation, maybe more. And it does provide an insurance policy for stocks, which can be a lot more volatile than bonds. Speaking of stocks, as we look at that part of the ledger, we prefer remaining diversified. However, we do lean towards a cross-section of a little bit more exposure towards U.S. companies, especially those with attractive growth potential. One benefit of this diversification across sectors is the ability to own high-quality companies that are less expensive than the broader market. So with that idea of looking at different types of valuation, let's look at this relative to some valuation dynamics in the next slide. So a few minutes ago in the presentation, we talked about AI and some of the tech stocks potentially being in a bubble. One sign of rising investor sentiment is a rising valuation, which we can see here in this sort of brown line, which shows that the broader U.S. stock market is more expensive now than on average over the past 5 years. Although you'll notice it's still a little bit cheaper than we saw when markets peaked out in late 2021. We use a metric called PE, or the price to earnings ratio, to measure how cheap or expensive stocks are. That's what the data you're looking at here. And if we think about going back to the benefits of diversification, one of the sectors that we own is healthcare. That's a group of stocks that are growing nicely. In addition, they're also trading at a less expensive metric compared to the broader market. And I think we do prefer this type of diversification. And as we sort of think through ways of owning stock markets, we think this is a way to reduce downside risk if some of that excitement comes out of some of the AI companies and tech stocks.
Mike, if I could jump in just for a second. So you mentioned a 5-year average, but it looks like we're looking here at more like 12 years plus or so on these multiples. So just to point that out. And then separately, though certainly linked here, it was, we talked about bonds on the front end. Usually it's the other way. We talk about stocks and then bonds, but we're talking about bonds because of yields and inflation. Could you just describe, if we were to overlay a valuation measure of bonds over the same time period, the direction of that chart from a multiple or a price standpoint, if you will?
Yeah, it's a great point, and thanks for the reminder. We've got a lot of charts going here, so yeah. Appreciate the historical connection there in terms of going back even further for stocks. If we were to look at bonds, so just broadening things out, if you were to go back, frankly, to the 1980s, this is where we had runaway inflation, stagflation, and frankly, things were pretty tough. And at that time, bond yields were extremely high, high inflation, high bond yields. Really, from the 1980s until, frankly, 2 or 3 years ago, we had this very long march of bond yields coming down, and kind of as that was happening, if you owned bonds, it was a good time to own them, but you always worried in the future that yield was going to get lower. We saw a big snapback up in calendar 22. So this is when the Fed got really worried about inflation and said, hey, wait a minute, we have to slow the economy down to stop this wildfire inflation. Started increasing interest rates. So we saw this sort of decade change in what we've seen in bonds. So in some ways, bonds got very, very expensive, if you will, really up until calendar 21 or early 22. And now, if you think about what you can get in bonds, we showed a chart earlier, 4.25 yields on the 10-year Treasury. That's a risk-free rate. That's pretty good. It's frankly higher than what you're seeing with inflation. So in some ways, bonds look cheap. They look very attractive. At the same time, to your point, Mike, looking here over 10 plus years, stocks are getting a little more expensive. So it is a reminder, and I think as we look at balanced portfolios, we do want to have a full allocation to bonds as well as stocks. As stocks are, both are looking pretty attractive, but we do have to respect that fact that stocks, although there's a lot of growth there, AI is driving a lot of excitement. However, valuations are up, and bonds certainly on the flip side are offering a lot of value. We want to make sure we're fully invested there as well.
Great. Thanks, Mike.
Absolutely. So good points here in terms of looking at kind of both sides of the asset classes on investing. With that, as we kind of hit that point home, and I think we talked about it here, frankly, wanting to own stocks and bonds in a big way, as both are relatively attractive. Let's take a quick look at some alternative methods and some ways of thinking about market timing, which may be less attractive. Let's go to the next slide. Okay, so kind of a last piece within our portfolio positioning is looking at being fully invested, frankly, the idea of owning both stocks and bonds. The alternative would be sitting on more cash in case markets correct, sort of waiting around and doing a market timing approach. And we generally prefer to be fully invested. Looking at this idea of market timing, it can be a pretty tough battle to fight because it requires making two really good decisions, getting out and getting back in at the right time. And so to underline this point of some of the challenges with market timing versus being fully invested, let's take a look at the next slide. Okay, so before we get into this connection between market timing and thinking about long-term business cycles and stocks, which are in the short term up about 9% year to date for the S&P, let's turn to our next poll question, and I'll hand it back to you, Mike.
Yeah, so this is just simply looking at returns on equities. As Mike said, stocks are up, have kind of a year's worth of return in the first quarter, as measured by the S&P 500. Stocks are up about 9% in the first 3 months of the year. Given that and the current level, which let's call it around 5,200 on the S&P, do you expect stocks to finish the year higher, lower, or about the same from current levels? All right, Katie. All right, 44% say higher, Mike. Quarters say lower, and the balance, which is about 30%, say about the same. So we'll be the optimists and say that 74% say about the same or higher, and the other quarter say lower.
I know, again, great feedback here. I appreciate everyone's optimism. I hope there's some wisdom in the crowds here, and this is propels us forward. There is a reasonable chance of markets moving higher, especially going back to even some of the AI stocks. We are seeing demand for a lot of those products continuing to grow. Stocks are responding to that increasing demand, so that could be something that helps us continue. Despite stocks getting a little bit more expensive, although a little bit cheaper than where they were in 2021. A couple of things to think about that could help stocks out this year. There's a pattern where a lot of times when stocks have a great start to the year, first 2 or 3 months, a lot of times that does carry through for the balance of the year. So that nothing specific about that for 24, but that's something that sort of would suggest history's on our side. Another item, which we'll expand on a little bit more in a minute, is elections. So a lot of times as you think through the presidential cycle, the election year tends to be a pretty decent year. So we've got a couple of parts of history on our side, and we'll see if stocks continue to do well for the rest of the year. So a couple of these thoughts are generally a little more short-term in nature, thinking of how a stock would do in a calendar year. If we put aside some of the short-term views and sort of look longer term, and take a look at this chart, we can see company profits in the blue line does grow in fits and starts, but if you look back, it has grown about tenfold over the last 3 decades. There's some pretty significant growth. We can also see stocks in the white line, generally tracking what's going on with stocks. Again, some bounces up and down, but generally tracking that over time. As we think about sort of maintaining a long-term approach to helping clients meet or reach financial goals, we view a fully invested investment strategy as the best way to take advantage of some of these long-term trends in profit growth and stock performance. So that's sort of the way we view the business cycle and sort of thinking through fully invested investment allocations. With that, let's turn to the next slide. So speaking of long-term stock performance, some investors worry that elections can add new risks to stocks as they consider either market timing or maybe keeping some more cash on the sidelines to limit political risk. Before we discuss stocks and elections, let's turn to our final poll question. Back to you, Mike.
Very good. Thanks, Mike. We've got 7 months and a bit until the presidential election in early November. Based on where we stand now, which depending on the polls you read is fairly even. With Joe Biden and Donald Trump as the respective party nominees, who do you expect to win the presidential election in November? Joe Biden, Donald Trump, or someone else? Okay, Katie. 61% say Joe Biden will win re-election, Mike. 30% say Donald Trump, and 11% say someone else. There you go.
Very good. I'm going to keep my comments focused on investment implications here, but yes, I think looking at polls, it would suggest it's a toss-up. Certainly a very strong chance that Biden could come back and win another term. As we think about the investment perspective here related to the election, we have seen some pretty good performance for the majority of Biden's term. We had a tough year in 22, but it really roared back in 23. And if we look at some of the charts below, and sort of think through the benefits of looking at that historical data, at FBB, we are unlikely to implement kind of a significant change to our strategy if we do get a repeat win for Biden. As a reminder, trying to time the market, get in and out based on one of the political parties controlling the White House, it really does produce terrible long-term results. I think as we can see in these charts here, over a decade or much longer. Really, the best long-term strategy has been kind of taking a fully invested approach, which is something that we would favor. So with that, sort of walking through our positioning and also sort of thinking what might impact markets related to the election, let's turn to some concluding remarks. Next slide, please. So as we look at today's market and also look ahead for the balance of the year, we do see both upside potential and some downside risk as we think through what's going on with AI and some of the growth stocks. We're seeing demand continuing to grow, and however, on the other hand, we're also seeing stocks get a bit more expensive. So looking through both sides of that. In addition, we are seeing some other risks, potentially another bout of surprise inflation, or perhaps the Fed coming in and keeping interest rates higher for longer. However, despite these sort of upside and downside scenarios in the short term, we do continue to recommend fully invested portfolios as a good way to capture both durable growth in company profits, as well as have exposure to attractive long-term bond returns. So with those wrap-up comments, we will now turn to your questions, and I will hand it back to you, Mike.
Great, thanks, Mike. Here's the disclaimer slide I mentioned on the top end here as we go over maybe the first question. We'll stay here for folks to read. So Mike, tying back into one of the early themes we discussed was inflation and extinguishing the remaining flames of inflation. David asked a good question, which is, are you looking at official inflation numbers? So let's assume that means as those released by the government, various things, CPI, PPI, et cetera, or actual household inflation, which of course is the pocketbook. So you want to talk about the two there, please?
Yeah, absolutely. So it's I think as you think through kind of overlapping circles of the economy and the stock market, there's overlap, but it's not a complete kind of one for one. So our job as investors is to pick asset classes, pick stocks, but we have to be aware of what's going on in the market. And a big factor has been inflation. It came in roaring hot. It's cooled down, but it's not quite we're not quite done with bringing it down. The question is, how do you think about it? How do you get very specific? A couple different ways. I think the consumer price index, or CPI, that's probably the most widely used metric to think about where inflation is. Although I think another way to do it, and one of the things that we think about here at FBB, is behavioral finance, and what's kind of behind the numbers that's driving consumption, driving people to take action, and that leads to company profits, and that drives stocks. One item you can think about is, frankly, gas prices. It's a very kind of crystallized number. A lot of people see that, they see it constantly, and they sort of anchor to that. For example, there are certainly other metrics that impact sort of the basket of consumer items, whether that's staples you pick up in the grocery store, et cetera. But there could be a bit of a difference between just this CPI number you see on a headline in a newspaper, and just a lot of millions of people out there putting gas in the car, getting frustrated if that goes back up, and saying, hey, I'm not going to buy that washer dryer. I'm not going to take that other economic step because I'm worried about broader inflation. So there's a lot of overlaps here. I think in general, we're sticking with sort of the mainstream metrics, CPI. There's certainly others that the Fed looks at. There's one called personal consumption expenditures. We'll get that on Friday. But really just piecing a lot of these items together and also looking at how consumers are reacting. That's probably the best approach that we've found to looking at these metrics.
Very good. Also, kind of on inflation and rates, Doug asks, given the difficulty the Fed seems to be having squeezing the last percentage point from 3% to 2%, do you expect the Fed to delay interest rate reductions until later in 24, or are we now looking into 2025?
Good question, Doug. So, I think kind of a mainstream view is that the Fed will make 3 quarter-point cuts by year end, despite inflation remaining kind of around 3% at the moment. However, Jay Powell is trying to thread this needle between keeping rates too high for too long, which could cause a recession and unemployment. On the other hand, if the Fed cuts too early, the economy could roar back and inflation pops right back up. So Powell at his meeting last week with the Fed suggested that even if inflation is a little bit sluggish and not coming down fast enough, even if it stays kind of where it is or gradually comes down, it sounds like over the next couple of months, that would be good enough for the Fed to start cutting rates. We see pretty good odds of at least 1 rate cut this year, probably 2. Could we get 3? That's really going to depend on what inflation does. But I think there's a pretty good chance the Fed does want to at least start its move towards cutting at some point this year.
All right, so last question here for the moment on rates and inflation. We'll move over to some stock stuff. Sorry, before I do this, reminder to folks participating in the Q&A is right in the middle of the bottom of the screen. If you have a question, feel free to type it in. We'll get to it. Mike, Linda asks where we expect bond prices to be at year ends. She gives an example of 2 to 30, but maybe start with T-bills and the impact there, and out to 10 plus.
Yeah, absolutely. So I think the key sort of factors to think about here are inflation. What's that going to do, and what's the Fed going to do? Those are 2 sort of things that are critical. If we see inflation start to come down and the Fed decides to cut short-term rates, again 3 quarter-point cuts, that's kind of consensus. We could see short-term bond yields creep down, as those cuts kind of flow through. Right now, short-term bonds are yielding around 4.5. We could see that move below 4% into the high 3s. Bond prices would move higher. That's kind of the inverse action that happens in the bond market. Look, if you go out to the 10-year, we mentioned that I think the 10-year Treasury yields around 4.25. You might see that move down, maybe not quite the 3 quarter-point cuts, maybe somewhere in the middle. It tends to not quite move as quickly as short-term rates, but that's something we could see maybe around 4%. Going out longer term, the 30-year bonds, some investors or kind of consumers might be thinking about mortgages. Those tend to be coming in 30-year blocks, somewhat related to long-term bonds. Right now, mortgage rates, they've really spiked a lot over the last couple of years. They're a little over 7% now. If the Fed does cut short-term rates, you could see sort of a follow-through effect throughout the yield curve, and could see a little bit of impact there. Perhaps, again, not the whole 3 quarter-point cuts, but you could see some modest declines. So we'll have to wait and see. Again, a lot of that is really going to sort of be related to what we see with inflation and how aggressive the Fed is wanting to be as far as starting to cut rates based on that.
Okay, very good. Mike, Charles and David ask a similar question. What stocks or categories within AI, given that many different applications are hitting the market, are we interested in terms of investment strategies for portfolios?
Absolutely. So as we think through, again, as kind of a key part of the presentation today, are we in an AI bubble, and how is FBB responding? So as we think about it, we're applying a broader investment research process to this AI theme. We generally look for companies that are sort of in early innings of some significant change, and we look for those companies where we see the business meeting or exceeding investor expectations throughout a transformation. There's a lot of change and transformation happening with AI, so it's something we're taking a close look at. As we see opportunity for companies within this AI food chain, we have included several of those in our client portfolios. I'll run through a couple or a few. So Adobe, this is kind of a software company. It's does a lot with creating visual marketing, et cetera. They are producing some AI related software. So that is certainly a company towards the forefront of using this technology. I mentioned cloud computing earlier as a tech kind of theme that's been growing almost for a decade now. Microsoft and frankly Amazon are two of the top players there. Microsoft in particular, not only doing cloud computing, but is also as a big sort of partial owner of ChatGPT. This is the company or the technology rather, that is using AI to generate text, et cetera. I think OpenAI is the company that they own. So Microsoft's another one. Again, Amazon, these two companies they do a lot of cloud computing. It processes a lot of the AI data that's out there. So that's another way. You can go further and get into hardware, so the hardware food chain. So Taiwan Semiconductor, they basically are a manufacturer, sort of outsourced manufacturer of semiconductors that other companies design. So as other firms are designing AI chips, Taiwan Semi makes them, and so it is a diversified approach. They're generating a lot of growth. However, you can avoid sort of that boom bust cycle by diversifying there. So those are generally some themes that we're looking at. We're certainly open-minded to looking at other ways to participate. But again, I think at the moment we favor some of these companies where they're on their own, a lot of nice growth, and on top of that, they're participating in some of the AI-related growth.
Okay, Mike, Elliot asks, what's the House view on tax policy post-election, better or worse? I'll take that one. The same, Elliot, first, at least for the first year of the next administration. I think most people know that the Trump tax cuts without an extension are set to expire at the end of 25, so beginning of 26. But at least for filing purposes, 24 and 25 should be the same, unless there happens to be something that Congress, enacts, retroactively, which is not typically in the cards. It's actually not typically in the cards that the previous assumption that Congress works together and gets something done before something like this expires we can't take that as gospel either. In the 2010 to 2012, really early 2013 timeframe, we did not have agreement on sunsetting tax laws, and that things were kind of in limbo for a while. So I would expect there to be some change, and that certainly would be dependent upon who is elected, whether the Trump tax cuts are extended or some version of them, likely to be kept in either regard. Though if Biden is in Democrats have control, I would expect marginal brackets to creep actually back up. Though some of the tax giveaways, like your limit on salt for state and local taxes, some of those things are actually likely to stick around. Okay. Let's see. Mike, Claire asks, curious on your thoughts on Boeing's problems impact on which one? It's been about 15 years of Boeing problems, but no, obviously things have gotten worse for the plane maker. They just announced this week, Mike, that the leadership, including chairman of the board and the current CEO, are on their way out. Specifically, Claire is asking the impact on the airplane manufacturing and airline businesses, along with any broader reach that this may have.
Absolutely, it's a great question, Claire. So Boeing is not a name that's kind of in our broader portfolio at the moment. We're certainly taking a look at everything. We are participating in the sector. We'll touch on that in a second. So company's got a lot going on. I think, as Mike Musio said, it may be tough to summarize everything here. However, from a broader perspective, Boeing's frankly still catching up to where they were in 2018. That's before they had two crashes that came after that time. A big slowdown in their production. A lot of very, very difficult times for across the board there for Boeing. However, we have seen a pretty big recovery in global travel demand, and that is creating this huge multi-year waiting list for planes, Boeing and as well as a competitor Airbus. So despite the challenges Boeing has seen recently with quality control generally, and the Alaska Airlines door falling off, and specifically, we do expect Boeing to expand its deliveries. They're likely to find a way to get there. Still at this trough level, still trying to catch up to where they were 5-6 years ago. However, you may see a bit of a slowdown here as Boeing and regulators work out their quality control. On a related note, so one of the ways that we've looked at the sector to get exposure for clients is through a company called Howmet Aerospace. Our analyst, Michael Brenner's done a great job doing some research in the area. This particular company makes engine parts for both Boeing and Airbus. So if there's a slowdown in one or the other, they've got some diversification. We do like this diversified approach to this business. It's got recurring sales. And it's sort of a more recurring type of business compared to some of the big assemblers, which can have more volatility. So lots happening here. Certainly, we'll catch back up with you later in the year as we get more news, but that's where we are at the moment in aerospace.
Okay, thanks, Mike. I'm going to take this one real quick. Based on research, any indication the U.S. government will surrender fiat currency in favor of regulated cryptocurrency in the next 10 years or so? Or is that a pipe dream? Anonymous attendee, all we have to go on is what Powell says. What Powell said this month, 3 weeks ago, we're nowhere near recommending or let alone adopting a central bank digital currency in any state or form. So we're gonna go with that. Okay. We will stay on crypto for a minute because we have a couple questions here. Mike, I'm going to combine them together. Mike and another interested attendee are asking what is our opinion on Bitcoin, and specifically vis-a-vis the new Bitcoin ETFs, which are new this quarter.
Yeah, so I think kind of continuing this theme related to frankly the Fed's view of crypto, which I think is fairly cautious or even skeptical. We also look at the asset class with some skepticism, and I think one of the concerns we have is we view it frankly as highly speculative. And in general, we would avoid the asset class before the Bitcoin ETF and frankly currently. However, to be fair, the current structure with ETFs makes it more user-friendly, easier to pick up and trade. However, I think for us, we do have concerns about the underlying asset class and generally would sort of steer clear of that type of speculation and recommend owning some type of asset where you can really understand the fundamentals. Looking at stocks and bonds, for example, these are related to companies. These are companies generating products. They're making sales. They're improving their margins. They're making profits. So as we think about reaching a long-term financial goal, we'd rather stick with something that you can really sink your teeth into the fundamentals and own companies or own bonds.
Okay, Chris asks, general thoughts on EV sector and the EV sector, excuse me, and investments there, Mike.
Yeah, so electric vehicles, certainly we've seen a lot of ups and downs here. Tesla, the big US company, bit of a roller coaster. So there's a huge surge a few years ago. It's been a bit rocky lately. I think as we look at exposure to that, we want to have a broader sort of view of what's happening here. Why are EVs out there? And they're trying to reduce exposure to fossil fuels, for example. So are there other ways we can maybe own this theme of EVs, but also own the broader type of theme? So Tesla, it's a name we own as a relatively small position. I think it's a pretty good business. It's likely to grow and gain share. However, it is something where you're going to see a lot of volatility, and so we'd rather be putting more investment into other sectors and tech and healthcare, industrials, et cetera. There are other companies, again, in a related theme. So, for example, NextEra and Utilities, they're the type of company building solar panels and farms, wind farms, et cetera. And so they're really sort of a very related theme, if you will, compared to electric vehicles. So probably some more ups and downs, a lot of things happening in China, flooding global markets with cheaper competitors. So there's a lot to watch there. I think it's helpful to have some exposure, but again, just sticking with more of a diversified approach is what we've taken at this point.
Okay, Mike Chopper says, let's see, how is the rising national debt going to affect major corporations' investment or growth plans? If you look, for example, with the administration's projections or suggestions in terms of increasing corporate taxes, what would that do to profitability? How could that affect the stock market?
Yeah, this question is going to be around for a long time. We've seen the U.S. government really just increase debt again and again, and this question it's a significant one. I think the issue is there some type of catalyst? Is there some magic number where if debt goes above this red line, is that really going to cause pain for companies? Frankly, no one knows. I think the less debt, the better, and as debt keeps going up, it is going to create some pressure. I think for us, as we just take a high level approach to how big of a risk factor is debt, I think our sense is that this is more of a gradual break on the economy. The more debt we have, it really does kind of squeeze out private sector investment and growth, that sort of thing. But it's not choking it off. It's more of just slowing it down. So this is certainly a topic we're going to be coming back to again and again. At current levels and rates, we are seeing the economy continuing to grow. Despite debt coming up, I think a much bigger concern for us would be, let's say, for example, inflation roars back up and interest rates go up, and the federal government is now borrowing and paying back its debt with this massive sort of interest rates. That would be a much bigger concern. So at the moment, our base case is that interest rates kind of stay where they are, maybe creep back down. But if that other alternative happens, we're going to be looking at sort of different types of companies, for example. So certainly a key factor, and we're going to continue to watch that here over the next several years.
Yeah, I can't help but think, Mike, that our former Federal Reserve governor, who's now the Secretary of Treasury, Janet Yellen, is just envision her kind of elbowing Jay Powell, saying, "Hey, a third of it's coming due here in the next 12 months. Refinancing that at something in the 4s or 3s would be better than in the 5s." So. Very good. Okay, general question here from the audience. What is the House view on deploying additional dry powder into equities? A good question, Mike. We're a percent from all-time highs in the stock market. Interest rates, short-term rates around 5%. We're in an election year. We talked a couple times about being fully invested, but what if somebody has dry powder, general dry powder that they would be adding in normally, and what if it's somebody sold something, they sold an asset, and they have $50,000 to invest? What should they do now?
Yeah, so I'll start out with the general case. We would want folks to be fully invested. So if your allocation is kind of 60% stocks, 40% bonds, we want you to get to that as quickly as possible, even at current levels. I think some investors could get spooked. Stocks are at all-time highs. AI, what's going on? Guess what else is at all-time highs? Corporate profits. Companies keep growing and they keep growing, and stocks are going to chase that. So that is something we want to participate in. So perhaps pivoting a little bit from more of a tactical perspective, let's say someone sold a house or that they came into some cash immediately. One approach, and frankly, this goes back to behavioral finance a little bit, putting that to work. One option may be doing that gradually over a number of weeks or months, not forever, but just not piling everything in one day, for example. If there is some volatility with stock markets, and if you spread out putting that money to work at least over a few weeks, that could help you hedge some of that risk. So that's a short-term approach, but then also I think that the longer-term view is wanting to get fully invested as quickly as possible.
Okay. One last question. I want to attribute this because it could, but just in general, as we push out here, Mike, and we talk about inflation and the Federal Reserve and maybe 2-3 cuts. As that continues to get pushed out, we all know that the Federal Reserve is not political, but as that continues to get pushed out, if June, which is a 70% probability today, but remember Christmas, March was an 80% probability of a hike, and that didn't happen. So if June comes and goes and we haven't done anything yet, and all of a sudden we find ourselves in the second half and a heck of a lot closer to an election, is the 2-3, 1-2 in terms of expectations?
Yeah, I think things could definitely get tricky for the calendar here, and you could even scroll that back further and say you've got the political conventions in August, and does the Fed want to be taking action closer to that? So I think a convenient time with the political calendar would be to take the first cut in June. However, the Fed wants to be responding to financial data and economic data, and if the data looks bad, they're going to be in a little bit of a pickle here, I think. So there is certainly a possibility, maybe you just get one cut. I think if there is something where the Fed does nothing until November, December, that's probably a bad outcome for markets. Is it game over? Probably not, but I think on the margin, you are going to see a bit more pressure there. So between now and June, it's going to get a little interesting as far as what the Fed decides to do. One option could be the Fed takes one cut in June. If inflation is still kind of high, maybe they hold tight there for a few months, but at least investors are comfortable that the Fed has started that cutting sort of path. They've gone down that, and they're unlikely to go backwards. So we'll see. It's going to get interesting here with Fed action, political conventions, and the election. I think the Fed's going to have to find a way to sort of thread that needle, but I think they've done that before, and I would expect them to look at all the data as they do that.
Okay, very good. That is all the questions we have, Mike. So thank you, Mike Bailey. Thank you, Katie. Again, thanks to all of you, our clients, our friends who've tuned in today. Should you have any questions or like to get more specific about any of the answers and how they might impact your portfolio and how that impacts your financial plan, please reach out directly to your portfolio manager. They'd be glad to help. Thanks again for being here. Have a good one. Goodbye.